Economics is a social science deals with the economic behavior of mankind. It studies the utilization of scarce resources of the society and how the various goods and services produced are distributed among the different sections of the society. Adam Smith, father of economics, defined economics as the study of wealth in his magnum opus Wealth of Nations. Economics is the science which studies human behavior as a relationship between ends and scarce means which have alternative use. Economic problem is the problem of unlimited wants and limited means. Moreover, the means have alternative uses. It can be explained in details as follows. 1. Multiplicity of wants. Human beings have unlimited wants. When one want is satisfied, another one emerges. There is a long list of wants to be satisfied one after the other. Two. Arrangement of wants. While all wants can't be satisfied at the same time, a particular want can be satisfied. For any individual, all wants are not equally important. Some are more important and urgent than others. Hence it is possible to arrange the wants according to the importance. Three. Scarcity of means. The various means to satisfy the wants of people are limited. The means or resources are in terms of money, time, natural resources, etc. They are scarce in relation to the demand. Four. Alternative uses of means. The various means are not only limited but they also have alternative uses. For example, a student can use his time either for studies or entertainment at a particular time. All these four basic factors give rise to an economic which is nothing but a problem of unlimited wants and limited means. Every society and every economy faces this problem of unlimited wants and limited means. This problem is termed as economic problem and it is universal in nature as it exists in both rich and poor countries. To solve this, a choice has to be made in the utilization of resources and satisfaction of wants. Thus scarcity, choice and efficiency constitute the subject matter of economics. Every economy has a limited stock of resources, viz. land, labor, capital, technology, etc. These have to be used for the production of various goods and services in the best possible manner. Goods and services are scarce in relation to wants. However, the problem of scarcity exists even in the richest of the richest countries. Due to the problem of scarcity, choice has to be exercised by every economy in the utilization of resources and satisfaction of wants. The choice has to be made in such a way that optimum resource allocation can be ensured. What to produce, how to produce and for whom to produce are the three main issues faced while making a choice. This implies that every economy must make a right choice about factor inputs and output. It implies the effective use of scarce resources in such a manner that maximum wants can be satisfied. If there is no efficiency, then people may be worse off than before. Ensuring efficiency in resource utilization is the essence of economics. It is an important concept. It arises due to universal problems, i.e. wants are unlimited, means are limited and they have alternative uses. At a particular time, they can be used for a particular purpose. The other uses have to be sacrificed. Opportunity cost of a factor of production is the next best alternative that is sacrificed. For example, a plot of land can be used for multiple purposes like construction of house or a commercial area. Once a purpose is decided, other has to be sacrificed. It is useful to determine the relative prices of different goods. For egg. While determining the price, the firm will see to it that the price of the bungalow is equal to the price of the 10 flats. It helps in determining the normal earnings of a factor. For egg. If a person is employed by a college, his salary may be 1,000 rupees per month. He can be employed by a financial institution, and if the salary offered is 12,000 rupees if it wants to retain him in the present job. It helps in decision-making and optimum allocation. For egg, a builder has a choice to build a bungalow or 10 flats using the same plot of land. In order to arrive at a decision, he has to compute the opportunity cost of building either of these two. Let us suppose the price of each flat is 20 rupees lakhs, then the total income he will get will be 2 crore. Suppose the price of bungalow is 3 crores. He can make more profits in flats. Rational decision-making is possible with the help of opportunity cost. The concept of production possibility curve, PPC, is given by the famous economist Professor Samuelson. It explains the basic subject matter of economics, namely scarcity of resources and the problem of economizing. The resources like land, labor capital, technology, etc. available to any economy is limited. An economy is said to be efficient when the maximum output is produced at minimum cost of production. This output is also termed as the least cost output. The production possibilities curve is also known as the transformation curve. To explain this concept, Professor Samuelson has assumed 3 conditions. 1. There must full employment and full production of goods and services. 2. The supply of factors of production is fixed. However, they can be shifted among different uses within limits. 3. The state of technology remains the same. Let us suppose an economy has certain amount of resources which can be used for producing 2 goods, namely rifles and bread. While the former is a defense good, the latter is a civilian good. If all the resources are used for producing rifles, then production of bread is impossible, and vice versa. The economy is supposed to produce a combination of both. The goods can be depicted through a table and a diagram. In the diagram it shows the schedule along which the 2 goods can be substituted for each other. If all resources are used for fine dining, the conferences reach 0 and vice versa. According to Professor Samuelson, substitution is the law of life in a full employment economy. The production possibilities curve or frontier depicts society's menu of choices. Function explains relationship between 2 variables. For egg. Demand for a good depends upon its price. It is expressed as D equals FP, where D equals demand, P equals price, and F equals functional relationship. The relationship between consumption and income is expressed as C equals Fy, where C equals consumption and Y equals income. Functions are classified as explicit and implicit function. An equation explains the relationship between 2 economic variables, namely the dependent and independent variable. An equation is true only for a specific value. The symbol equals is used in equations. For example, x squared minus 9 equals x plus 3, x minus 3, this identity is always true. Graphs are considered as very important in economic analysis. A graph is a diagram which shows the relationship between 2 variables. It is easy to represent 2-dimensional figure through a graph. For egg. A data can be explained in a bar graph. The slope is an important concept in economics. It refers to the change in one variable due to change in other variable. Slope is also popularly termed as the rise over the run. Here rise is the vertical distance while run is the horizontal distance. Incremental and marginal concepts are often used in business decision-making. While marginal concept is concerned with unit change, incremental concept is concerned with bulk change. For more insurance, the change in total revenue due to the sale of one more unit of output is marginal revenue. If a firm gets additional revenue due to a new decision like use of robots instead of human labor, it is termed as incremental revenue. Incremental concept analyzes the impact of a decision on investment, production, prices, etc., and ultimately on total cost and total revenue. Thus this concept can be viewed in terms of incremental cost and incremental revenue. Due to change in the decision of an organization, total cost and total revenue will in the decision of an organization, total cost and total revenue will change. The change in total cost is called increment cost and the change in revenue is called incremental revenue. Marginal concept indicates the change in total revenue and total cost due to unit change. Marginal cost is the cost incurred in producing an additional unit of the output. It is expressed as MC equals TCN minus TCN minus 1. Similarly, marginal revenue is the addition made to the total revenue by selling one more unit of the output. It is expressed as TRN minus TRN minus 1. Revenue function is an important factor on the supply side like cost function. It refers to the sales receipts. The revenue of a firm depends upon the quantity of output sold and price per unit of the commodity. It is the total receipts earned by the firm by selling the output. It is calculated as TR equals P multiplied by Q, where TR is total revenue, P is price per unit and Q is the quantity. It is the revenue obtained per unit of the output. It is expressed as R equals TR upon Q. It is the addition made to the total revenue by selling one more unit of the output. Symbolically, Mr equals TRN minus TRN minus. Cost of production is an influential factor on the supply side. It refers to the expenditure incurred on the various factory of production like land, labor, capital and organization which are used in production of a commodity. It denotes the remuneration paid to the factors of production for their services. While analyzing the data of a firm, the following types of costs are considered. It is the total expenditure incurred by the firm in producing a given level of output. It is obtained by multiplying factor prices with their quantities. It is expressed as total cost equals total variable cost plus total fixed cost. It is the total cost incurred on fixed factors of production. TFC remains the same at all levels of the output in the short run. In the short run, some factors are variable. The cost incurred on these variable factors is called total variable cost. It varies from the level of output. OFC is the total fixed cost divided by total units of the output. It is the total variable cost divided by total units of output. It is the variable cost per unit. It is the total cost divided by the unit of output. It is the average cost per unit of the output. It can also be calculated as the sum of average fixed and average variable cost. It is the cost of producing an extra unit of the output. It is calculated as total cost of producing n units of the output minus total cost of producing n-1 units of output. It indicates the change in the total cost due to the production of an additional unit. 1. Total product. It is the total quantity of the commodity produced by using fixed and variable factors of production. 2. Average product. It is the total output divided by the total units of input. 3. Marginal product. It is the addition made to the total output by employing one more unit of the input. It is expressed as MP equals TPN minus TPN minus 1. The concepts of marginal revenue, marginal product and marginal cost help the business firms in decision making. They have to take decisions regarding investment, production, use of more inputs, etc. To identify the equilibrium. Output, marginal revenue and marginal cost are required.